Coming up on Business Incorporated today, maize prices hit historic high with a 90-kilo bag now retailing at 6,000 shillings in Nairobi. Sugar imports declined in 10 months to October by more than half on the back of biting shortage on the world markets. Zimbabwe's finance ministry forecasts economy will grow by 3.8% in 2023. Thank you for joining us. I'm Will Ibang. Let's get the show started now with market numbers at intraday, where sentiments were negative, well positive in South Africa. It was up 0.34%. Egypt is closed today, but ended up over 1%. Kenya closed negative yesterday. Now we'll move over to the intraday numbers at the NGX to take a peep at what's happening there and to see how market is moving and what's moving the market and what's driving sentiments currently. We have Oluwaseun Dosumu, Head Investment Research at Party and Securities Limited, joining us now to give us more insights on that. Good afternoon, Seun. How are you doing today?
Well, I'm very well, Will. Good afternoon.
Now, Seun, what's currently driving sentiment in the market right now?
Okay, so when the market opened today, we saw that Nestle's price actually declined, or let me say dropped, by 10%. So we've also seen that there was a cross deal on MTN, and that the cross deal was worth 3 billion. So right now, if you look at market activities as at midday, we saw that the market is actually in the negative, and that's because of Nestle's 10% decline. Also, MTN's there was a cross deal on MTN to the tune of 3 billion. So right now, the market total value is about 3.7 billion. MTN has taken about 81% of that. So right now, like I said, the market is still negative. Sentiments are actually weak. A lot of positions are in the negative. I mean, if you look at the sector analysis, you would see that only the banking and insurance sectors are in the positive, and the gain is actually little. But if you look at the other sectors, such as the consumer goods and if you look at the consumer goods and the other sectors, they are flat and in the negative. And that is what's actually moving the market right now.
So what do you think is going to change? Do you think stocks are going to flip? Investor sentiment, what do you think? What are you seeing right now? Are they leaning towards the positive or negative at the moment?
Right now, they're leaning towards the negative, and it's not surprising. I mean, we've seen the positive move throughout the week. From the positive move actually started from last week, Friday. We've seen that move all throughout Monday till Thursday. So Friday is probably a profit-taking day, and we expect that investors will continue to come back into the market from next week, regardless of the rate hike from the MPC. And that is because yes, we know that activities whenever interest rates are high, it affects the equities market negatively. But given the inflation figure at 21%. Right now, investors are actually looking forward to making dividend plays. So right now, their focus will be on ensuring that they don't lose their return is not negative. That's the real return now, is not in the negative. And the only market that can actually give them that kind of good return is the equities market in a short period of time. So we'd see a lot of investors make dividend plays, come back into the market, and take positions and wait till the dividends are declared for the end of the year. One of the things that we've also observed is the fact that the numbers, the Q3 numbers, Q3 earnings, corporate earnings that were released were very impressive. A lot of companies, between 60 to 70% of the companies that released their results was actually quite good. So investors will also consider that and see that the market valuations, the price valuations of a lot of stocks are actually quite cheap. And a certain number of them are close to their 52-week low. I mean, like Nestle, for example, you would see a lot of investors come into those stocks, especially those stocks that pay dividend. You would see that those stocks will most likely drive the market towards the end of the year. I mean, investors should actually focus on the influencers. I mean, the influencers are actually the top 15 stocks in terms of their market capitalization. So those are the stocks that will most likely drive the markets in December. Okay. If you look at the historical trend, you would see that from June, or from May, sorry, let me say June, after there was a rate hike, by the MPC, the market has actually been on a negative downward trend. And for the month of November, in that trend, November is the only month that's closed in the positive. We expect that to also happen in December. And because, I mean, we're going to have the full year numbers coming, dividends are going to be declared. Some investors will just come in, take advantage of that, and also exit, given
Okay.
the, difficult macroeconomic space.
Okay, so
So, yes. Okay.
Sean, you mentioned that the market has not reacted much to the MPC rate hike by the central bank. How much of this has the market priced in? What are we seeing? Are we going to expect the market to continue pricing in these talks? I mean, this rate hikes or this hikes in different aspects of the economy, or do you see investors going to probably sell their stocks off much later?
The market's valuation, the overall market valuation is actually attractive, and there's still a lot of value in the equities market. So regardless of the rate hike, even though that is a major impediment, that's a major headwind in terms of the market performance, I still see some investors, come into the market. I don't see the overall market, I mean, moving at an astronomical rate like the way we saw it during the second quarter or the first half of the year. But I still believe, or we believe that the markets will still close in the positive in terms of the year-to-date return. The year-to-date return at the end of the year would see that investors will take position in largely capitalized stocks, because those stocks actually move the market, and most of them have actually reported positive numbers. Numbers, I mean, they've done, at least for a sizable number of them, some of them have done above 90% in terms of their Q3 earnings, 90% above what they did during the full year 2021 numbers. That's what actually drives some investors back into the market, especially if they pay better dividends than what they did last year. So we'd actually see, investors cherry pick on those selected stocks, especially those ones that pay dividend, and that should actually keep the markets in the positive
Okay, so
by the end of the year.
so
Albeit, I don't see exceptional, performance. The
so
performance will be moderate. We don't expect that much rally in the market, especially in December.
So those are your expectations for the year end. But what are your expectations for today? How do you think the market is going to close?
We based on activities that are happening in the market, the overall sentiment is actually negative. So we expect that the market will close in the negative today. As at midday, the market was already down by 0.32%. And we're seeing that the stocks, only about 5 stocks are currently in the positive. And these are mid to small stocks in terms of their market capitalizations. Those stocks actually don't really move the market. So we expect the market to close in the negative, and we expect renewed interest to come into the market from next week, because some smart investors will start to take positions. Right now, we have more investors in the market than traders. People who would take long plays, because that's the only way you can actually make a lot of money, given a lot of return, given the macroeconomic space. We know that this is a pre-election year. We know that generally market activities in terms of macroeconomic indices are actually not looking good. We saw that the GDP number that came out yesterday, that was released yesterday, showed a GDP decline, from the previous, previous quarter. That number obviously would spook some investors. So, well, despite all this news, I think that we believe that some investors will still take position in largely capitalized stocks. So today, the market might actually close in the negative, but come next week and in December, we expect to see, some positive momentum flow back into the market.
Thanks so much, Seun Dosumu, Head Investment Research, Parthian Securities Limited. Thank you for sharing your insights on the program.
Thank you.
So we'll move over to markets in the Middle East, where the UAE is open right now and trading with sentiment in the red. Abu Dhabi is down 0.23%. Dubai is down 0.78%. Saudi and the Qatari indexes closed negative in yesterday's trading session. Now, let's take a look at some economic data coming out of Europe right now. Janelle Dumalon joins us from Berlin with the update. Janelle, some optimism. Yeah, German business sentiment is improving, according to a much improved barometer that we've seen after all the gloom. What's lifting the outlook?
That's right. Finally, some optimism. Germany's IFO Institute has a closely followed monthly confidence barometer surveying around 9,000 representative companies. So last month marked a rise for the second month, indicating a lifting mood among the German business community. Now, worth noting that this uptick follows 4 months of actually falling readings. And that's as the impression here seems to be taking root that an impending recession might not be as severe as originally feared. Remember, this recession is a byproduct of record high inflation as Russia's war on Ukraine impacts energy supply here. But there's a growing belief that the government's relief packages, for example, a 200 billion euro package to help insulate businesses and citizens from the worst effects of inflation, will actually help stop prices from rising. There's also growing confidence that Germany's efforts to fill up its storage reserves have paid off and that a severe energy shortage this winter might be headed off. And just this morning, we also have fresh GDP data showing that the German economy increased by 0.4% in the third quarter compared to the previous quarter. Yet another indication that, at least from the German perspective, things might not be as bad as originally thought.
Be that as it may, Janelle, higher inflation still have Germans worried, according to a new survey. How have spending habits changed?
Well, prices are still what they are, right? And, given this week of surveys here in Germany, here's another one. Inflation has 63% of consumers in Germany spending less. On the other hand, 20% say they have not cut back, but anticipate that they will eventually have to. So just as a reminder, inflation here in Germany is 10.4%. That is still a post-war record. And according to Germany's Federal Office of Statistics, household energy bills here were up 55% in October year on year. Groceries have risen by 20%, clothes nearly up by 6%. And as a result, Germans are in fact cutting back. 60% of those surveys say they are spending less on food, and a similar percentage say that they're cutting back on clothes. A third say they're traveling by car and plane less. There are also signs that even beyond this, Germans are looking to live more sustainably, even beyond this crisis period, by cutting back on clothing spending like they are now and buying more energy-efficient devices and appliances. But when this crisis period is going to end is still obviously unpredictable. And as such, it's really difficult to know with any certainty how consumer spending in Germany will really be reshaped in the long term. But there is potential for change there.
So let's take a look back now, Janelle, to markets activities this week. What stood out for you?
Now, what I'm about to say is all related to what we've been talking about. Yesterday, for example, we saw European stocks hit their highest level in 3 months after that German business confidence report I mentioned earlier came out. And on top of that, it's been a generally more rosy week than we've seen. Yesterday actually marked the third day of gains for European stocks. That's also as investors seem eager to interpret the latest signals from the Federal Reserve as heading into a more dovish direction. Today, however, we've seen a somewhat less enthusiastic, flatter opening as inflation woes continue to weigh on retailers. Remember that today's Black Friday, the start of the holiday shopping season. And that's obviously on investors' minds that we might not be seeing the record profits that previous years showed us before.
We just hope Christmas is going to be not a gloomy situation for us. Janelle, thank you so much for the updates and sharing that with us. Now we'll move over to Asia, where stocks were mostly lower as markets in the U.S. were closed for the Thanksgiving holiday and slated to end its session early on Friday. In Japan, the Nikkei 225 fell 0.35%. The Topix index ended its session at 2,018 points as the nation's capital city saw the highest core consumer price index reading since 1982. In South Korea, the Kospi fell 0.14%, and the S&P ASX 200 in Australia rose 0.24% to close. Now, stock futures in the U.S. inched cautiously higher on Friday ahead of a shortened trading session. Futures on the Dow Jones Industrial Average rose 50 points. S&P 500 futures added 0.19%, and NASDAQ 100 futures were up 0.18%. Now, Wall Street looks set to close out an upbeat holiday-shortened week after the Federal Reserve's last meeting minutes added to expectations that monetary policy tightening may slow down. Welcome back. And let's look at the Kenyan economy now, as the Central Bank of Kenya hiked interest rates and the Kenyan shilling dropped to a new low against the dollar earlier this month. Let's talk to Matt Kindiger, practice leader, Sub-Saharan Africa Frontier View, to share his insights on this. Matt, what is your outlook on this situation for the shilling, given the slide in forex reserves?
Hi, well, thanks for having me on the program today. So in short, we are expecting more depreciation of the shilling over the next 3 to 6 months. And this is for a number of reasons. It's very clear that the central bank has been intervening into the FX market in Kenya, trying to limit the pace of depreciation of the shilling. And we expect this is happening for a couple of reasons. One is that it wants to contain inflationary effects from the cost of imports. It also wants to limit the debt servicing costs for the government's debt that is denominated in foreign currency. In our view, this is not sustainable, and this is because a relatively buoyant Kenyan economy is drawing in imports, which are very expensive because of high commodity prices at the moment. And we are also seeing an incredibly strong dollar and rising interest rates in the US and the Eurozone. And this will draw capital away from Kenya. So in our view, we are expecting to see the central bank relent to an extent, probably allow a more sudden or larger depreciation of the shilling at some point over the next few months. The shilling is likely to reach 135 or 140 per dollar by the end of next year. So certainly more depreciation to come.
But do you expect the central bank to continue raising interest rates over the coming months?
Essentially, yes. So we were previously expecting the central bank to limit the pace of interest rate increases, and this is because inflation was relatively contained in Kenya. But now we are expecting a slightly more aggressive set of interest rate increases. And this is because forex reserves, as you mentioned, are very low. And this is dwindling because of the dollar's strength and because of capital outflows. Inflation has also risen quite substantially and consistently over the last 10 months. It's risen every month, and it's now at about 10%, which is far above the central bank's target. And also, there are another couple of reasons. One is that the economy continues to grow relatively strongly, and so the central bank does have scope to to raise interest rates without reducing the pace of economic growth substantially, and it can avoid a recession even if it increases interest rates. And finally, interest rates are actually relatively low in Kenya by recent historical standards. So they remain below pre-COVID levels. They're at just about 9%. So there is some scope again to raise interest rates.
Okay, so but given the foreign currency shortages that have emerged in recent months, Matt, can businesses expect to find any sort of relief?
Yeah, so this is actually something that most of our multinational clients operating in Kenya are concerned about. They've seen increasing foreign currency shortages emerge, and this is fairly novel for Kenya. It hasn't really been an issue over the last few years until recently. In short, yes, we would expect some improvement in access to foreign currency, and this is because, as we mentioned earlier, we are expecting some greater depreciation of the shilling. This will provide a bit of a relief for forex access, but the degree to which forex access improves really does depend on the pace of depreciation. And this depends on a number of factors, including what happens with the dollar globally, as well as investor sentiment towards Kenya. So, for example, if we see a deterioration in public finances that is worse than we're currently expecting over the next 3 to 6 months, you could see more capital outflows from Kenya, and this would aggravate foreign currency shortages. So certainly we would hope there to be an improvement in forex access. If not, then we could expect a very vibrant parallel market for foreign currency to emerge in Kenya, and this obviously causes some business planning problems. So yes, hopefully we'll see a bit more depreciation, and this will provide a bit of relief.
I just want to cast a view, towards for next year. If you just give me a brief outlook, taking into consideration everything you've mentioned now, does it look good for Kenya?
So Kenya's economy is actually relatively upbeat and relatively buoyant, and this is because despite the foreign currency shortages, despite rising inflation, we've actually seen a very rapid recovery from COVID-19. And also, if you look at GDP data for the first and the second quarters of 2022, we've seen a real acceleration in growth in services industries. And this is very good news for Kenya, because this means despite a very weak performance in the agriculture industry because of the drought, we are seeing non-agriculture, non-manufacturing industries do very well. Certainly, there is a risk when it comes to consumer sentiment, and credit growth. As interest rates rise, we could see more expensive credit, borrowing costs will increase, and as inflation increases, we could also see consumers temper their growth, their spending outlook. So certainly there are some risks on the horizon, but given the resilience of the economy, despite the war in Ukraine, despite what's happening with high commodity prices and shilling depreciation, we're still relatively upbeat for in terms of our view for the economy. We are expecting the economy to grow by between 4 and 5% in 2022 and 2023. So we're sort of cautiously optimistic.
Matt, we're going to keep that optimism going, especially for the African continent as it is. Thank you, Matt Kinniger, Practice Leader, Sub-Saharan Africa Frontier View, for joining us and sharing your perspectives on the program.
My pleasure. Enjoy your weekend.
You too. Now, still in Kenya, Kenyan maize prices have hit a historic high with a 90-kilo bag now retailing at 6,000 shillings in Nairobi, pointing to hard times for consumers who will incur the high cost of flour. This comes just a day after Trade Cabinet Secretary Moses Kuria said farmers are hoarding 20 million bags of maize from this season's main crop season. Millers based in North Rifts are now buying the produce at 5,500 shillings from 4,500 shillings in the last week. Millers say the country is likely to run out of locally produced stocks by the end of January, a move that will add more pressure on prices. However, the government has announced it will be opening up a duty-free window for maize imports to bridge the deficit. Millers are arguing that they are not getting enough stocks as farmers are not supplying and cross-border imports from Tanzania and Uganda are fizzled out. Uganda and Tanzania are key to supplementing Kenya's stocks annually, and the lack of sufficient maize in these countries will add more pressure on consumers locally. Still in East Africa, sugar imports within the region declined by more than half in 10 months to October on the back of a biting shortage on the world market, which has seen traders struggle to procure stocks. Data from the Sugar Directorate shows traders imported 96,730 tons of produce from the common market for Eastern and Southern Africa as COMESA, down from 201,555 that were imported in the corresponding period last year. The decline comes when the cost of the commodity in the country has skyrocketed, with a 2-kilo packet retailing at 312 shillings from 230 shillings in January. Traders have been grappling with a shortage of sugar from the COMESA countries, a move that will see Kenya fall short of its import quota from the member states. Now to Zimbabwe, where the economy is forecast to grow by 3.8% in 2023. And this is driven by mining, construction, agriculture, and tourism. The country's finance minister, Mthili Ncube, who made this known on Thursday, says next year's growth is expected to be powered by favorable international commodity prices, a good agricultural season, stable power supply, and tight monetary and fiscal policy, among others. Mr. Ncube mentioned that the government will continue with its tight fiscal and monetary policy measures to keep inflation under control. He added that Zimbabwe's economy is forecast to grow by 4% in 2022, slightly down from 4.6% initially projected due to the impact of high inflation and curbs on speculative borrowing. Now, Ghana's government is considering a 30% haircut on foreign bonds and the suspension of interest rate payments to domestic bondholders in 2023 as part of debt restructuring efforts. According to the country's Deputy Finance Minister, John Kuma, the restructuring would enable government to conclude a support deal with the IMF and build buffers to be able to repay bondholders once it emerges from the crisis in a couple of years. Earlier on Thursday, Finance Minister Ken Ofori-Atta announced a series of measures to cut expenditure and boost revenue in a bid to tackle spiraling debt. Ghana is negotiating a relief package with the International Monetary Fund as the cocoa, gold, and oil-producing nation faces its worst economic crisis in a generation. And that's it on Business Incorporated. I'm Willie Bung. Thanks for watching. See you next week.